In 1923, an entrepreneur named Clarence Saunders successfully trapped Wall Street's elite in a mathematical corner that should have cost them millions. He played the market's own game, cornered the supply of his stock, and won. But as the billionaires faced total ruin, the New York Stock Exchange simply stopped the clock. They paused the market and rewrote the rules mid-game to ensure that instead of collecting his winnings, Saunders lost everything. This is the story of the Piggly Wiggly short squeeze, a moment that proved outsmarting the market means nothing if you can't beat the people who own the exchange. To see how one man threatened the entire financial system, we have to start in 1916. At this time, grocery shopping is a slow, manual process. You don't walk the aisles and pick out your own apples. You walk in, hand a paper list to a clerk behind a counter, and wait while they fetch your items one by one. This counter service model required a massive, expensive payroll just to keep the store functioning. For every item sold, a human employee had to walk the floor, making the entire operation inefficient and expensive to scale. This gap in efficiency created an opportunity. Clarence Saunders saw a way to ruthlessly optimize the grocery business by removing the clerks entirely. Saunders invented the self-service store, calling it Piggly Wiggly. He installed turnstiles and provided shopping baskets, forcing customers to do the labor of picking their own items off the shelves before walking to a dedicated checkout aisle. Saunders' philosophy mirrored the modern strategy of Jeff Bezos. At Amazon, Bezos built a global giant by replacing chaotic human energy with cold, precise logistical efficiency. While Bezos uses software and automated conveyor belts to track every second of fulfillment, Saunders achieved a similar level of operational control using nothing more than wooden shelves and clear price tags. By cutting out the middleman and slashing overhead, Saunders expanded Piggly Wiggly to hundreds of stores across the country, eventually taking the company public on the New York Stock Exchange. Saunders took his company public during a wild era of Wall Street speculation. In the early 1920s, the stock market became a playground for investors who were buying millions in shares with only 10% down, using massive margin loans. This chart shows the mechanic of short selling, how investors bet on a company to fail. You borrow shares from a lender and sell them immediately for cash. If the price drops, you buy the shares back for pennies, return them to the lender, and pocket the difference. Seeing that a few Piggly Wiggly franchises were struggling, a group of wealthy Wall Street bears began aggressively shorting the stock, hoping to drive the price down and bank a fortune. These investors assumed Saunders was a simple grocer they could easily steamroll with financial leverage. Saunders reacted to the short sellers with the aggression of a street fighter. He took the attack personally and decided to launch a secret counteroffensive. He took out massive personal loans and quietly began buying back nearly every available share of his own company. This created a trap known as cornering the market. As the bears kept selling borrowed shares, Saunders kept buying them. Eventually, the supply of shares available on the open market hit practically zero. Saunders was applying his grocery store strategy to the financial system, cutting out the middlemen and exerting total control over the supply of his own stock. In 1923, Saunders announced he owned the entire float and demanded the short sellers return their borrowed shares immediately. Because the bears were legally obligated to return those shares, and Saunders was the only person who owned them, he could set whatever price he wanted. He jacked the price up, leaving the elite bears facing total financial ruin. By every standard of the free market, Saunders had outsmarted the professionals. He had won the game. Facing the loss of millions, the Wall Street bears didn't accept a defeat. Instead, they went to the governors of the New York Stock Exchange to ask for a bailout. The exchange was run by the same financial class as the short sellers. They looked at Saunders' win and decided they could not let a grocery store owner bankrupt their peers. The exchange took 3 steps to save the bears. They suspended all trading of the stock, granted the short sellers an unprecedented extension to find shares, and then permanently delisted Piggly Wiggly from the exchange. The rules of the market were abandoned the moment they threatened the wealth of the people in charge. This intervention was fatal for Saunders. Because his stock was delisted, he couldn't sell it to pay back the massive loans he had taken to buy the shares. He was forced into bankruptcy and lost his stores, his mansion, and his fortune. This mechanism, protecting elites from the consequences of their own bets, reappeared in 2008. When massive banks faced collapse due to their own subprime mortgage investments, the government stepped in with a $700 billion taxpayer bailout to save them. Both events demonstrate a recurring pattern in the financial system. While small entrepreneurs face bankruptcy for their risks, the most powerful players are shielded by institutional interventions that effectively socialize the biggest losses. Clarence Saunders proved that you can out-innovate your industry and even win the market's own game. But his story remains a warning. No amount of genius can save you if your opponent is the one who writes the rulebook. Thanks for watching Irony Economics. If you enjoyed this look into the madness of the markets, hit that like button, subscribe, and let me know in the comments which multi-billion-dollar disaster we should decode next.